Everyone thinks the 2008 financial crisis was solved. Banks were saved. Markets recovered. We learned our lesson, except nothing was fixed. The toxic assets were never removed. They were moved. The leverage wasn't reduced, was disguised. And the next collapse? It's already built in. Welcome back to Past to Profit, where history meets money. Here's what they told you. The government stepped in, bailed out the banks, and stabilized the system. Crisis averted. Atomy saved. And for a while it looked true. Stock markets hit record highs. Unemployment dropped. Housing prices came roaring back. But underneath, the same cracks that caused 2008 are still there. Wider, deeper. And this time, we've run out of tools to fix them. Let me show you what really happened. And why the next crash won't just be bad, it'll be worse. To understand why 2008 never ended, we need to go back to what actually caused it. It wasn't just subprime mortgages. It wasn't just greedy bankers. It was the entire structure of modern finance, breaking under its own weight. In the early 2000s, banks figured out how to turn risk into profit. Took mortgages, loans to homebuyers, and bundled them into securities. Mortgage-backed securities. Then they sliced those bundles into layers. The safe ones, the risky ones, the toxic ones. And they sold them. To pension funds, to insurance companies, to other banks. All over the world, the rating agencies, Moody's, Standard & Poor's, Fitch stamped them with triple O ratings. The highest grade, as safe as government bonds. Except they weren't, because the mortgages backing those securities, a lot of them were garbage. Subprime loans given to people who couldn't afford them. No income verification, no down payments, adjustable rates that would explode after 2 years. It didn't matter, because the banks weren't holding the risk. They were selling it. And as long as housing prices kept rising, the whole machine kept running. Homeowners refinanced. Investors made money. Banks collected fees. Everyone won, until they didn't. In 2006, housing prices peaked, then they started falling. Suddenly, people couldn't refinance. They couldn't sell. When their adjustable rates kicked in, they couldn't pay. Defaults spiked. Foreclosures flooded the market. And all those mortgage-backed securities, they started collapsing. The problem was, nobody knew who was holding the toxic assets. Banks didn't trust each other. Credit froze. Lending stopped. And in September 2008, Lehman Brothers, one of the biggest investment banks in the world, went bankrupt. The entire system seized up. Stock markets crashed. Unemployment exploded. The global economy was hours away from total meltdown. That's when the government stepped in. The Federal Reserve slashed interest rates to zero. The Treasury bailed out the banks. Congress passed the $700 billion Troubled Asset Relief Program, TARP, and it worked. Markets stabilized. Banks survived. Panic subsided. But here's what didn't happen. The toxic assets. They were never actually removed. The banks didn't sell them. They didn't write them down. Instead, the Federal Reserve bought them. Through a program called quantitative easing, the Fed created trillions of dollars out of thin air and used that money to buy mortgage-backed securities and treasury bonds from banks. The toxic debt moved from bank balance sheets to the Federal Reserve's balance sheet. The problem wasn't solved. It was transferred, and it's still there. Before 2008, the Fed's balance sheet was under $1 trillion. By 2014, it had ballooned to $4.5 trillion. Today, it's over $8 trillion. That's not recovery. That's life support. But it gets worse. Because the banks didn't just survive, they got bigger. In 2008, the government decided some banks were too big to fail. Well, they bailed them out, merged the weak ones with the strong ones, and created even larger institutions. Bank of America took over Merrill Lynch and Countrywide. Wells Fargo bought Wachovia. The banks that caused the crisis became more powerful than ever. And the regulations meant to prevent another collapse? Watered down, rolled back, ignored. Dodd-Frank, the financial reform law passed in 2010, was supposed to rein in Wall Street. It created new oversight, required stress tests, banned some of the riskiest practices. But by 2018, key parts of it were repealed. Lobbying worked. Politicians caved. And the safeguards disappeared. So here we are. 16 years after 2008, and the system is more fragile than ever. Let's talk numbers. Corporate debt in the United States is now over $11 trillion. Higher than before the crisis. Household debt, over $17 trillion. Also a record government debt, $34 trillion. And climbing total global debt, $315 trillion. Nearly 4 times the size of the global economy. We didn't fix the debt problem. We made it bigger. And we did it by keeping interest rates artificially low for over a decade. Cheap money flooded the system. Companies borrowed to buy back their own stock. Investors chased returns in riskier assets. Housing prices soared again. Everything inflated, but productivity, wage growth, real economic output, stagnant. We rebuilt the illusion of prosperity. Without the foundation, now let's talk about what's different this time. Because the tools that saved us in 2008 won't work again. Back then, the Fed had room to cut interest rates. They went from 5% to 0%. That extra cushion gave them space to stimulate the economy. But after 2008, rates stayed near 0 for years. And when they finally raised them, they didn't get very high. So when the pandemic hit in 2020, the Fed cut rates again, back to 0. And they printed more money, trillions more. The balance sheet exploded. Stimulus checks went out. Markets soared, but inflation came roaring back. The thing central banks feared most. Now the Fed is trapped. If they keep rates low, inflation spirals. If they raise them too high, the debt becomes unsustainable. Defaults rise. Markets crash. There's no good option. Just bad and worse. And it's not just America. This is global. Europe's banks are still loaded with bad debt from the sovereign crisis. China's real estate market is collapsing under the weight of speculation in ghost cities. Japan's been running negative interest rates for years and still can't generate real growth. Everywhere you look, the same pattern. Massive debt. Low growth. Central banks out of ammunition. The system didn't heal after 2008. It adapted. It found ways to keep the illusion alive. But illusions don't last forever. Here's the part that should terrify you. In 2008, the problem was subprime mortgages. Toxic loans packaged into securities today. The problem is everything. Corporate bonds that should be junk. Rated as investment grade. Zombie companies kept alive by cheap debt. Unable to generate real profit. Private equity firms leveraging buyouts to the hilt. Cryptocurrency speculation. Meme stocks, SPACs, NFTs, every corner of the market has been inflated by cheap money and speculation. And when confidence cracks, it all comes down together. 2008 was a financial heart attack. The system seized. But it survived because the Fed resuscitated it. The next crisis won't be a heart attack. It'll be organ failure. Multiple systems breaking at once. And this time, the Fed can't just print more money. Because we already did that, and it gave us inflation. The bailout playbook is exhausted. Let me give you a historical parallel. In the 1930s, after the Great Depression hit, governments tried everything to restart growth. They cut rates. They spent money. They bailed out banks. And it worked. For a while, but the real recovery didn't come until World War II, when governments mobilized entire economies, when debt didn't matter, because survival did. We haven't had that reckoning yet. We've just delayed it, and every delay makes the bill bigger. So what happens next? Nobody knows the exact trigger. It could be a sovereign debt crisis, a corporate default wave, a housing crash, a geopolitical shock, but the mechanics are predictable. Confidence breaks. Credit freezes. Asset prices collapse. Defaults cascade. And because everything is so interconnected now, because debt is everywhere, the collapse spreads faster than it did in 2008. The government will try to step in again, print more money, bail out more banks. But this time, the public won't accept it, because we've already seen this movie, and we know how it ends. The rich get richer. The banks survive. And ordinary people pay the price through inflation, unemployment, and austerity. 2008 taught us one lesson. The system protects itself. Not you. And 16 years later, Nothing has changed. Except the stakes. The toxic assets are still there. The leverage is still there. The systemic risk is still there. We just stopped looking. Because it was easier to believe the problem was solved. But problems don't disappear because you stop talking about them. They grow in the dark until they can't be ignored anymore. And when that moment comes and the next crisis hits, don't be surprised because the warning signs are everywhere. Record debt, inflated assets, exhausted central banks. A system running on faith and fumes. 2008 didn't end. It just went underground, and the collapse we avoided then. We're still heading toward it, just with more debt or risk and fewer options. If this gave you a new perspective, hit subscribe. History has the answers, and on Past to Profit, we'll show you where to look.